Okay, welcome everyone. We would like to welcome you to North Coast Angel Fund's educational session, Angel 101. This is the second session we've had, and it was terrific to see over 100 people registered. That's about double what we initially thought we would have. And to see so many people out here who have braved the hurricane force winds today, we're pleased to have everyone here. This is going to be a fast-moving panel. We're going to have a lot of good things to talk about, but first wanted to do three important things. One is first to thank Key Private Bank for their support and sponsorship, which allows us to do this today. And I want to acknowledge Greg Keegan and Ryan Kilbane from Key who are here today. See Greg in the back? Ryan is right there. So please join me in thanking Key. I think many of you know that the Key Private Bank has the wealth management function at Key. They do that very well for a number of our members, and they also work with us closely on the fund accounts for North Coast Angel Fund 3 and North Coast Venture Fund. They've helped us through some interesting situations over the years for us and our portfolio companies, and we're appreciative of their ongoing support. Item number 2 is that despite Key's generous support, there is a price of admission tonight, and that is to complete this survey. Feel free to complete it anonymously, but we would love to know what you thought, what we can do better, which items you think are worthy of follow-ons, and what we should think about doing differently the next time. There is a generous area here for people to fill out comments, and we'd love to hear what you are going to say. We got a lot of great comments last time, and we've incorporated much of that feedback into tonight's program. Number 3 is that as an inducement to all of you to stay until the very end, we have a door prize. And the door prize is a bottle of Angel's Envy Kentucky Bourbon. They don't pay us to say this, but this is a delicious and appropriately named bourbon. Angel's Envy has helped us recently, in fact, celebrate some of the fun wins of angel investing and also to lick our wounds on some of the more discouraging outcomes. So please stick around. We will have a drawing and we'll be happy to give that away. So this is our agenda for the night. You should have it on your table in front of you. Also in front of you is a schedule of the North Coast Angel Fund 3 regular monthly member meetings. I think you know that North Coast is a private investor group. However, we do like to have guests. We like to have people who are interested in the environment, who are considering angel investing. Because of what we do and some of the SEC limitations, we are limited to having accredited investor guests. But if you are not a member of North Coast and you would like to attend one of our meetings later this year, please let me know, please let Daniel know, and we'd be happy to get you on the list and see what it's like in a typical member meeting where we have companies present, diligence, decision-making, and we get updates from our portfolio companies as well. Also in your packet is some information on how we conduct diligence and a fairly thorough glossary of angel investing terms. There's a lot of good stuff there. If there's additional information you would like, we are happy to share our standard term sheets, some of the interesting case studies and articles that we've seen and used. We don't want to kill the forest by printing everything for you today, but there are a lot of really great resources and we'd be happy to share with you. So terrific folks here on the panel coming up. We have people with expertise in entrepreneurship, technologists, physicians, general business people. We're going to ask people to go fast introductions, fast questions, fast answers. We're going to have time for Q&A from the group on each different panel. And we'll ask for everyone's speed as we go forward. We're trying to pack a lot into a relatively short session. We were able to do it last time, and I think we can do it again here tonight. So we're going to go through a bit of an overview here now. We'll start with the who, what, when, where, and why. So the who is many of you here tonight. Accredited investors, people who want to support or at least want to consider supporting high potential entrepreneurs in the region. We've had a lot of experience over the past 10 years, much good experience, some poor experience, learned a lot from it, And we think the angel investor community over the past couple of years has really come together in a way that's going to allow us all to be more successful going forward. So what is early stage investing in technologies? So this is going to be companies that are medical, that are software, that are advanced materials, electronics, controls, and that when has to do with early stage, post idea, but pre-true commercialization. So as a fund, and what we'll talk about here tonight, we tend to support companies that have at least a minimum viable product. They usually have a couple people on the team. They've proven something. If it's software, usually someone has used it or paid for it. We can call and talk to customers. That's the general setting that a diligence panel will talk about considering companies for. And if it's a life science technology, typically they've at least had successful preclinical or animal trials and are in a position to scale up to do work in a human clinical setting. Cleveland is different than other parts of the country, not surprisingly, and we think any good angel investing strategy has to be tailored to what we have in the region and what we don't have. That said, just like the earth is getting flatter, there's more access to deals all across the country. Investors across the country have access to our deals. So when we talk about deals and deal terms, we'll acknowledge that and think about how we want to orient some of our companies and their structures with what's being done in other parts of the country. And then the why is because we think there are enough high potential entrepreneurs, high potential companies that it is worth the time and energy of an investor group and a support network to drive these companies forward and support them. And I think we've seen in Northeast Ohio and Ohio more broadly over the past couple of years, really just in the last year, Federman Meds, Cardinal Commerce, Explorer selling to IBM, Assurex selling to Myriad, a lot of good outcomes where companies are selling in the hundreds of millions, or in the case of Cover My Meds, into, I wish there was some sort of slip there I could identify, but perhaps not, though we do wish we were in the deal. $1 billion exit, which is phenomenal. It's something I think a lot of people in Ohio might not have envisioned was possible just a few short years ago. So for those of you in the back who can't see, the caption at the bottom, it says, if we pull this off, we'll lead like kings. And this is the high risk, high reward notion of early stage investing. What we see here are the two Spider founders, which I think is typical. What you don't see here, though, is the 20, 30, sometimes more little Spider angel investors, people who've taken the early risk, early on, put capital behind the company, and helped to support it to get where it is at this point. It really does take a group. Investing at this stage doesn't tend to be a lone wolf activity, and we think it's more successful, more likely to be successful when it's done with a group of people who are working together. The landscape is important. What we do at North Coast is just a small part of it, but at North Coast we have 3 different angel funds, over 200 people who show up to meetings like this, who will consider writing a check directly, and we hope will leverage their time, energy, experience, and their networks to help the companies be successful. That's what it means to be an active member. We've made 43 investments over the past 10 years. When I first saw this chart, this is a PwC Venture Survey, I was thinking what many of you were thinking, which is, where's our bubble? We don't have there's no bubble between New York City and Chicago there. So despite all of our activity, we don't register. That said, there's more venture now in terms of activity. They're increasing numbers, even though we've been through a little bit of a dip of venture capital active here in the region. There's definitely more money at the seed stage, which is largely driven by the state, between what we have, other angel groups, jump starts, flash starts. There's a large number of early stage investors. So in some ways, it's never been a better time for the earliest seed stage companies. And these are the types of groups here that are investing in Ohio-based companies. So we are seeing an ecosystem. And I guess I should have mentioned Cardio Insight, where I see part of the team here from another successful Cleveland exit, waving in the back, yes, which was a terrific sale to Medtronic, and still quite a Cleveland-based team, I understand. So to state the obvious, angel investing is hard. Most angel investment deals, which we'll talk about, do not ultimately succeed. And investments can fail for a wide variety of reasons. Markets are sometimes ultimately not as attractive as we might have thought they were. Oftentimes the solution that a company brings to market is not as compelling as we might have thought. Often it's a challenge. These customers who we expect to either use something, take an action, or God forbid, pay money for something, it's harder to get customers than many entrepreneurs think. The competition is always tough. The more attractive an industry is, the more competitors you tend to see, and it really gets down to team, team, team. And I think you'll hear that on the diligence panel. So one of the long-standing debates in angel and VC circles is horse versus jockey, right? Would you rather have a terrific first-rate CEO with just a good market opportunity, or would you want to have a terrific market opportunity with just a pretty good CEO? In a perfect world, you would have both. In Northeast Ohio, more often than not, we're forced to choose. Most deals have hair on them. It's not meaning to say that these are not high potential deals, high potential opportunities, but they're few and far between situations where you'll find a seasoned entrepreneur with sufficient industry expertise with a terrific product in a high growth market that is raising capital here. Right? Typically, you need to be willing to take a little bit of a risk here, and all of the deals we've seen over the past 10 years have had some sort of hair on them. So evaluating entrepreneurs is difficult. All entrepreneurs are optimists, which is good, right? If you are an entrepreneur and you are not an optimist, you shouldn't be in the business. But too much optimism can be fatal. And optimism can be contagious, right? There are often times where in retrospect we look back and we as investors have had happy years. We know entrepreneurs want to see the reality that they believe will happen. We know they want to tell us what we believe, and you just can't take anything at face value. Most entrepreneurs, like most early angel investors, don't always know what they don't know. One of the things to realize is that most of these ventures will fail, and that's the inherent riskiness of any individual investment versus thinking about these opportunities as a portfolio. Most of the failures will result in 100% loss. So unlike later stage private equity where in many cases you can get your money back, you can get most of your money back, there are always business combinations and transactions to recoup. Most of the time when things go bad in angel investing, they go really bad. And losing all your money, and that's it, is actually known as the perfect loss. And it can get worse than that. We won't talk about all those details, but there are a lot of headaches that can get involved that actually are worse than losing all your money. The wins will take a meaningful amount of time, and it never happens quickly. So has everyone seen a couple of these over the years? So this is the typical hockey stick projection. We pulled this from an unnamed presentation, but we probably have 500 of these in our files. This is the vision. This is plan A, right? If everything goes right, here's what can happen. At North Coast, our very best company, Assurex, which has since exited, part of a publicly traded company, is in that realm of $100 million plus revenue going forward. They missed their projections the first 5 years. They obviously caught up, they did some terrific things, but we don't try to get too hung up on this vision. We try to better understand what is the market potential, how flexible are the entrepreneurs, and what is a likely outcome versus simply the best case. This is an interesting graphic we got from the Angel Resource Institute, which is started by the Kauffman Foundation, and probably the best place to get angel-related data. It's a study of exits over time. And what it shows is less than 5% of the outcomes are in the 10x to 30x or more range. So I think this supports the notion that for those of us who want to build a portfolio, that's an important thing because ultimately a small number of your investments will ultimately drive the return of the company. And not surprisingly, every entrepreneur thinks they're going to be there, right? And when we write the check, we all think we'll be there too, right? Because none of us would write a check if we thought it was going to be a loss. That's part of the pragmatic approach that we think needs to be taken. So to tee up diligence in the conversation we'll have here on the panel, the diligence that we do and we think effective investors do at the early stages is very common sense based diligence. Trying to understand, is there a real market here? Is there an opportunity? Is there pain? Is there some dynamic about the market today that is attractive enough for a new disruptive force to come in and justify risk capital like you would provide? Is the solution that the entrepreneur is presenting credible, right? In many cases, there are terrific problems to go and tackle. but does that entrepreneur have an approach that will really resonate? Can they do it, right? Many plans are not actually executable. Many plans are not executable by the team that you have in place. Again, back to team. In many cases, even though they can be delivered, there's not a way to make money in that industry. And it's a real shame when that's only discovered 4 or 5 years later. So we try to think about what the dynamics are, who will pay, for whom are you creating value, and ultimately, who will buy the company, who will see a sustainable competitive advantage and want to purchase the company. And then lastly, what is the return potential? Can we as investors make money from this? And all those early items really have to fall in place for that to happen. So a lot of things are new and developing. The VC landscape is always changing. Deal terms are always changing. We're seeing a shifting, later stage, bigger dollars. There's always movement here, and we need more capital in Northeast Ohio. Flash Starts is a terrific accelerator. We look forward to them becoming bigger, to having more companies created here, to having a more engaged corporate community that can help to spur technology's innovation, and to getting more capital, because we believe if we, the collective we here, had more capital pointed at the earliest stages, we would draw out many entrepreneurs who see risk and have families and careers and are less likely to take that plunge unless they see a supportive environment here. There's also new resources. The notion of crowdfunding is something that has developed over the past couple of years. It's still slower on the SEC side than it looks like it is in terms of some of the platforms, but deals are getting funded on AngelList, deals are getting funded in other places online, and all companies in Cleveland should at least be thinking about raising money from other parts of the country simply so that they have greater levels of optionality. So with all this risk, because you're going to lose your money most of the time, because it will take a long time to have the wins, and these headaches here, why would anybody do this? There are a couple answers. One is you learn a ton. Over the past 10 years, we've dug into genomics and neurostimulation and advanced e-commerce. Lots of interesting deals, interesting people, the entrepreneurs, the people in the room who are investors. It is fun. It's more fun when you win, but it's actually fun going through the process here. It's a lot of fun to give back, to help entrepreneurs potentially be successful, to create wealth, to create jobs. There are companies in our portfolio. OnShift is a great example where there are going to be 200 people working there by the end of the year. I think they're in 160s, 170s today. Fast-growing company, pointed in the right direction, but there are pockets all over Cleveland where our companies have 50 people, 40 people, 30 people. So it really is creating something that we think has potential. And then lastly, to make money. I don't think any angel investors would get involved in the activity if they didn't believe it was going to ultimately be successful on a portfolio basis. And despite all these great intangibles, if it doesn't work as an investment, it doesn't work overall. So that's something we try to focus on and ensure that only high potential deals come in, because at the end of the day, I think if the investment community here has negative experiences and is funding companies that don't have the potential to be successful, it won't be a longer term viable activity. So with that, we are going to invite our first panel up to join us. We have 3 raised seats here, which are precariously positioned on the riser, but we think are mostly safe. We have 1 microphone which we will pass across. And we'll start out by asking each individual on the panel to give a 30-second introduction, and we'll dive into
Hi, it's Todd. So I'm Sharon Fay. I was previously principal at Cully Fay Interactive, and I am just recently joined Broker Savant as their chief product officer. Broker Savant uses machine language and natural language processing to process commercial real estate documents, so very excited to be there.
Apparently I'm the head of cardiac imaging at the Cleveland Clinic. Dr. Scott Flam, and I'll see any of you after this for consultation.
The insurance plan as well.
My name is Charles Stack, and I'm the founder of both Flash Starts and StartMark, which is an accelerator where we invest in the earliest stage companies and then have a big co-working space where they can go and grow and grow and grow.
thought I recognized you.
I know.
Rankin, Rackley, a biomedical engineer by training. I came to Cleveland to attend Case Western Reserve Medical School, and I've spent 26 years at the Cleveland Clinic. And now I'd like to think that the rest of my career is angel investing. So I'm glad to be here, and thank you for the invitation.
All right, the first question is for Dr. Flam. Sorry about that, Charlie. I wish I had someone to blame beside myself.
I consider
That's
it a big promotion.
yeah. So we'll start with you though, Charlie.
Go ahead.
What type of opportunities are you looking for as an individual angel? How do you think about even defining an area of opportunities to look at?
Well, let me flip that around. All the companies we reject and don't invest in, it's uniformly because their ideas are too small. If it's not, because the odds of success are so high, you need to make sure that the return when you have a success is enormous. So we turn down good people and good ideas all the time. It's got to be a great idea. It's got to be really big. And let me differentiate. We differ a little bit from some of the other investors in this region in particular, where we don't try to validate market size, because for the companies that we really like, the market is not established yet, because what they're doing is something that's going to pay off in enormous returns down the road. So if somebody presents us with an analyst projection that a particular market is going to be this big, it's usually too late. I want to hear ideas that I haven't heard before for markets that don't exist or are just now starting, not something that exists currently.
And then Ray, as a physician, you obviously bring a domain expertise to this. Do you try to focus in areas you're most familiar with, or are you interested in branching out and looking at different types of opportunities?
Good question. So I spent about 8 years formally learning finance, science, and technology, but I spent 30 years trying to understand human behavior. And I still haven't mastered that. So I got the science, technology, and finance down. That's learnable. Now I'm just trying to find the right people to do the right business with. So I'm open to any technology, and you know, some of my bigger successes have been in situations I didn't know anything about per se. I certainly love doing due diligence in a short amount of time on things I like. I haven't restricted myself yet.
So good segue then for Sharon. How important is CEO founding team compared to the other areas you might consider diligence?
Well, I think, you know, you kind of cued that up with the horse versus the jockey, right? I mean, I think when we look at founders, you know, one of the things that we talk about a lot when we're doing diligence is the coachability of the team, right? Coachability of the founder. We all have our blind spots. And so, you know, we discuss what happens when a CEO comes up against a blind spot, right? Are they open to the ideas and experiences of other people around them? And I think that's what we at North Coast can bring to that entrepreneur through this relationship is, you know, a network of people who've kind of been there and done that and have expertise in those areas. And we can bring that experience to bear for that entrepreneur. So if they're coachable, you know, I think that's one of the most important things.
And Charlie, you mentioned big opportunities that might not exist yet in understanding how big they could be. So, you know, outside of being Peter Thiel and being prescient, how do you think about, or how should the average investor think about assessing a market opportunity that is that far ahead of the curve?
So, you know, the world, thankfully, mostly, is constantly changing. And there's new technology, there's shifts globally, there's megatrends that are occurring, both ones that we're vaguely aware of, ones we have no clue about. But keeping a good eye on what those trends are, what the new technologies are, gives you the opportunity to look at where there may be new untapped possibilities. And that's really what we're looking for. And you know, without question, it's a wild ass guess a lot of times, because some things don't pan out as you expect, and the other half of the equation, they pan out way faster, way better than you might have expected. And I have all sorts of examples of both of those. I mean, I'll give you two. The internet, way bigger than even I expected early on, seriously. And crowdfunding has taken a lot longer to become a huge success than I expected.
we lost 100% of our capital in a crowdfunding-based company several years ago, so we would have a similar experience there. So Ray, since you invest in life science and software, what are some of the differences in how you go about diligence or what you have to consider?
For life science, a longer time frame, a lot more regulatory risk. IT, that's more Charlie's area. I love the guys in that space. Not a lot of proprietary. I love IP. I demand IP, and I'm never going to get that with an IT thing. So then I know that I need a fast jockey, and I need big money, and I need people that talk about sales and marketing with IT. So it's a totally different game. And it's just, I don't look at IT as just a way to diversify my portfolio, but people get into that game easier with lower amounts of money and lower head cost. But I quickly look at head counts on IT compared to my life science company. So it's a total different due diligence, but it's an important part of the diversification of your portfolio.
And then Sharon, how structured is your diligence process? If on one extreme, here are 10 things you look at, you score each one, you see what comes out at the bottom, and if it's greater than a 92.3, you invest, right? On the other, you have 3 lunches, you see if there's confidence in the team and the market, and you go. Where are you?
Oh, where am I? So I'd like to say that I am pretty diligent when it comes to conducting diligence, but you know, I think our process at North Coast is fairly interesting. The way, you know, we request a bunch of different types of documents from the company. The diligence team has an opportunity to review those documents, to come up with questions. We get together as a team. We voice our issues, concerns, questions. We go back to the company again and see more documentation. So, you know, from my perspective, I think that the process is fairly diligent. But I will say I'm not sure that that really matters, right? You can turn over all of these rocks, but does that guarantee that you're going to pick a winner? And, you know, I don't think it does, right? So while we might be extreme in our diligence, or I might be extreme in my diligence, it doesn't guarantee that that company is actually going to be the big win for us.
And just to stay with you, Sharon, how do you know you're done? At what point are you in diligence and say, ta-da, I'm either investing or I'm not investing?
Oh God, I think it'd be, you know, when we're tired. The members are just tired. You know, I think there comes a point in time where we've raised the questions, we've asked the questions, you know, and we've listened to the diligence team members' responses, and you know, we've kind of come to the conclusion that we're comfortable with this or we're not. And I think that's when we're done, right? I mean, I think it's really more of a comfort thing, and I think too we're on a kind of a timeline. So I think having a timeline and knowing that we've got a member meeting and we need to decide whether we're going to present this for investment or not certainly helps us come to a conclusion for diligence.
Then Charlie, outside of the small market, what are 2 red flags that when you see that's your mental cue to stay away?
Well, I don't know that I have red flags. I mean, our process is both similar and different from what North Coast does, partly because what we do is different. So we added last year a labs program that sits in front of our accelerator. And so we do 3 to 6 months of due diligence on every single team before we actually do an investment. So that's changed the dynamic, the process. If you're looking at due diligence, it's kind of 4 categories. There's the team, the idea, the product, and their execution. What we've really gotten better at, and where I think we've improved the process significantly because of the extended time frame we have in due diligence, our ability to evaluate execution has gone way up. So I think that's, I know it's not a red flag, but it's more like a green flag, in the sense that we have had teams in the past that had seemed to have a good team, seemed to have a good idea, a good product, but couldn't execute their way out of a bag. And that's been a big change from our standpoint.
Ray, how long do you spend on diligence?
Just the right amount of time. Some people need it, some I need to do a lot, some very little. I'm a little probably quicker than what I heard Sharon describe. Usually my founder in startup company needs to be moving pretty quick, so they don't need a 6-month due diligence, but it just depends, like Charlie's actually founding companies versus investing in them later, so I think that's a whole different dance and walk, but if they kind of answer the little checklist, the thing I enjoy about being part of this membership is I depend on you guys to really do some of the due diligence that helps me move faster, so this, and many of you in the room are part of that process, so I'm gonna move pretty quick. What was your question again?
How long does it take?
Yeah, I don't want to spend more than 2 weeks.
Okay.
You know, I think as Charlie said, you got so many deals and time to look at. I know that most VCs or people are gonna maybe do 3 or 5 deals a year. You're gonna have to move pretty quick.
And then Charlie, when you say no, when you break up, how do you do it? What do you say? How do you try to be positive and constructive and respectful while saying no?
Well, I'm not sure we try those things. We just usually say no. Honestly, it's for the entrepreneur's best interest, because if they have a stupid idea in a market that's not going anywhere in a bad team, the quicker you can break up that mess up, the better off everyone's going to be, including the universe.
Yep. Never thought about the benefit of the universe.
So I think the other misconception is that people think they have to make the right decision right then and there, like this whole due diligence. I'm going to sprinkle in a little money early, I mean, test them. I don't think that you're going to make a bad decision, and I'd much rather come in later if I've told someone no. I'd like to find out that no was the right answer and stay in touch. But I may want to come in later after someone else paid for all their mistakes and pick it up. So I don't know, I say no in a very kind way, because I will stick around.
Okay. So do a quick lightning round, just down the panel. 1 to 10, how important is intellectual property?
I'll
Patents,
start.
trademarks.
Almost zero.
Yeah, I would agree for software.
Everything, because then you're in a commodities market. And I don't want to be in a commodity. I don't want to try to get 10x out of commodities.
So 0, 0, 10? Okay. Are you willing to sign a non-disclosure agreement with an entrepreneur?
All together now?
If the deal's really great, I've signed them against my wishes, and I've used them as a founder strategically against strategics to make sure they don't shop around to talk to someone else. So it's a great strategy if you use it for the right time of whatever part of the angel investment cycle you're in.
No.
Yeah.
And then last lightning round, then we'll do questions from the audience. When you're being pitched by an entrepreneur, whether it is a elevator pitch, they've literally caught you on your way out of Starbucks, or you're sitting down for a 10 or 20-minute pitch, what's the most common mistake that you wish entrepreneurs knew to do differently?
Oh, they all just stay in the weeds. I mean, that is, and that stays with them for a really long time, because their head's down in something they love, right in the dirt, dealing with the worms, and they're talking to somebody who is, at least 6 feet higher, right? And they fail to get grasp that they have to get you down there and give you some overall perspective, because all of our brains require, slotting. So, what market are you in? What country do you live in? What universe do you see? I mean, they all start way too low.
I think this is similar for me, but starting with technology instead of, what problem are you trying to solve?
And to me, they're trying to solve the problem with something they need, and I want them to solve something I want. And needs and wants, they haven't done that much thinking yet. And I think I heard last time from Ross Wheeler there, people really don't know what I need out of the deal. I need a 10x deal. If you can't show me that path, you shouldn't even call me. And I think I can get a 20% return with Warren Buffett a year. I don't need anything less than 10x. And I think a lot of times they haven't done the due diligence to come back and show me that's what I want to do.
Questions from the audience? Bob?
Yeah, at our annual meeting of the Angel Fund last week, Clay said that, or Todd, I forget which, said that 70% of the people we invest in will or have failed, and we will get most of our return out of the 10% that doesn't fail. what, if anything, could we do in due diligence to learn better and not invest in the 70% and figure out who's going to be the 10% a little bit better? It's just a little bit better would tremendously increase our returns.
Easy question. Who wants to-
I mean, I already gave the answer to that. Spend more time with the companies. And
Yeah.
it's.
Well, you do that, yeah.
I know for a fact I mean, our companies this year are significantly better than our companies in the previous years because we took 30 companies in January, February and spent 3-6 months with them. And at the end of that time, it was easy to pick the top 6.
So you just started the procedure where you spent several months with them.
And we give them milestones. I don't know if I mentioned that, but we give them milestones and targets every week. And you learn who executes and who responds to coaching so much more effectively than in any different type of diligence process. And I can't prove it yet because we have only been around for 3.5 years. We haven't had the exits yet because our time frame is even longer than North Coast's because our whole generation earlier. But I'm very confident that it's going to dramatically improve our success rate.
I think some of these numbers of 2 out of 10% is going to make 10%, 1 out of 10 is going to make it. That's also, we've got so much technology now that helps you do your due diligence that we didn't have 5 years ago when Fund 2 started. So I think the only other mistake is you can't invest on a group think mentality. North Coast Angels does a great job of the due diligence, but they can't think for you. And they have a great model that says, I'm going to sidecar the hell out of this one, but I'm not going to do that one. So you're paying an admission fee, in my opinion, to be a part of this group. It's cheap for the amount of return you get, but it ultimately is your decision why you pick a winner or not North Coast Angels.
I totally agree with that. And we have 3 partners at Flash Starts, and our model is not vote 2-to-1. It's I'm a champion for this team, and any one of the other 2 partners can stand up and say no. Doesn't have to say yes, but it's more I champion this team, and I dare you to say no to this. And that way, we're more likely to not end up with mediocrity.
Another question?
Go ahead. No.
Yeah, I was going to say I don't know that I can answer this question because I haven't actually. I'm so new to North Coast. I'm a member of North Coast 3 that I haven't figured out what it takes, what we could do in diligence to pick the winners.
Mike?
So for each of the panelists, what was your biggest due diligence failure personally?
Yeah, mine right off the bat, I forgot to look for a credit score on one of my founders, and if I realized how bad his credit was, I would have made more sense about what his decision making was like. It's just an easy.
We've made a couple of errors on founder commitment, where I think the market was there, the opportunity was there, but honestly, they just gave up. And I think we could have, it was our first year in particular, we could have done more to kind of measure the stick-to-itiveness and tenacity that was, in hindsight, lacking.
I think one of the things that I recall was laying in contingencies, and this is really more in the terms of the deal, but laying in contingencies that made sense at the time, but as a company progresses, those contingencies may not make sense anymore, and the entrepreneur is faced with either meeting those contingencies or getting the money, or following the path that's right for the business. And so, I think in hindsight, it's we've got to either believe in the entrepreneur and the business and go for it, or not and don't.
And just to put an entirely different spin on the answer to that question, the least due diligence I've ever done was the largest return I ever had. I only offer that up as a fact, and take what you will.
Time for 2 more questions.
My question is about pricing. How much do you do with pricing when these guys come in, and how much do you improve it?
Pricing the deal or pricing the product?
Pricing the product.
Yeah, that's a great question and extremely difficult to answer because there's so many variables, and I think we see a lot of entrepreneurs leave a lot of money on the table because they price it either from the inside out or from their perspective and not the customer's perspective. And one of the key things we hammer at over and over and over again is you got a value price. It has nothing to do with your costs. It's what someone will pay for it, and asking them what they're paid for it is not the right way to get that question responded to correctly. So coming up with a set of mechanisms, like one thing we recommend is set a huge list price and discount until somebody agrees to pay, right? And just, back your way off of that. And you can do that when you're an early stage company, because you can just say, well, here's our price, but you're our first customer. So we're gonna knock 98% off for this price. And then, you kind of work your way up, and the next time you knock off 80%. And sooner rather than later, you'll actually have a price that the market will bear.
And I would say, for me, first of all, as a product manager, lifetime product manager, pricing is difficult. But one of the things that I look for is a recurring revenue stream. I like companies that have a strong recurring revenue. It becomes an annuity. I think they're valued higher, and so that's one of the things that I look for.
And then another part of the answer to that question is, one of the things we learned from my own startups is if you have an innovative idea, you don't generally want to add an innovative pricing model to that, because that just confuses the hell out of your customers. So if the idea is really innovative, I would stick with a pricing model that the customer's familiar with. But if you have something that's a product that people are familiar with, then you add an innovative pricing model, that can work. But two together, people don't buy.
Last question?
How many of your angel deals actually have revenues, though?
Yeah, I've done 20 deals since 2002, and 2 have exited greater than 10x, as shown on that chart. The other 60% are going to be making revenue, and I disagree with Todd that everything's a complete 100% loss, because I always get a tax write-off.
Yeah, I think we'll talk about 1202 and 1244 stuff later on, but that's an excellent point. Ours, let's see, we probably have, we have 1 success out of our first company revenue, 2 out of our second cohort at revenue, 2 out of our 3 out of our third, and interestingly, the class that just graduated, 6 of the teams, 3 of them are at revenue, so higher percentage this year.
Yeah, and I think just from a deal perspective, right, a company doesn't necessarily have to have revenue when they come before us at North Coast to be screened. We actually invested in a company that had an idea, was beginning to execute, and this was a company where we did lay out contingencies and they were able to meet their milestones. So this was even before they were generating revenue or even had a product.
Well, thank you very much to the panel, and we'll invite the next one up. So as Clay and Michael have come up, I'll just mention that earlier today, as an example of a pricing question, Clay and Daniel and I were with a technology entrepreneur CEO in town who used to run another company, and that company was the largest customer at the time for one of our portfolio companies, a company which we think is doing very well, will ultimately be successful. We're pleased with it. And we just acknowledged to this CEO today that you were in fact our first big customer. And the CEO, without really pausing, said, yeah, we really like the company, really like the product, we'd have paid 3 times more for it. So unless you ask, meaning unless you test the waters and try different pricing, I think it's dangerous sometimes to assume that any entrepreneur or any one individual knows what the market will bear for a given product. Michael, quick introduction.
Hi, I'm Michael Ellis. I'm a partner with the law firm of Buckingham Doolittle. I am a corporate attorney who has done a significant amount of angel fund work, whether it's for the startup companies, the angel investors, the VC firm. I've also been a angel investor in a lot of deals. I've had much more success in the first than I have in the second, but I'm still waiting for the second.
And I'm Clay Rankin, Managing Director of North Coast Angel Fund, and been investing in these early stage activities for the last 30 years.
Great. So, Michael, for those in the room who have not made many or perhaps any angel investments, when you see a deal you like, you write a check, you hand them the check, what do you get?
What you get is really the opportunity to put more money in the next time they make money. Okay. But what you'll get is, depending upon the terms, it's very often the very initial investment is a convertible note. That's a case where the company does not yet know its value, or there's a disconnect between what you think the company is worth at that stage and what the founders think. So you basically kick the can down the road saying, I'll do a convertible note and we'll value it at when you've proved the concept and we have the first real North Coast Angel or Jumpstart or someone valuing it at that time, and you come in at a discount to that. You know, from a angel point of view, if you can get the people to come in as common stock, and basically they'll have 10 or 15%, they really have no rights as minority shareholders, that's wonderful for the investor, that happens all the time. It's later on in the deals where you'll get the concept of convertible debt, convertible preferred stock, or convertible debt that is convertible into convertible stock on a bridge level.
Clay, seed investors, angels here, should they be leaning towards debt structures, convertible debt, or equity?
I think this is a highly debated topic. We hear of other angel groups around the country that only do debt. I think my view of the option is that this is a very risky activity that we're getting into. And unless you're dealing with something that's of relatively short-term nature, you aren't rewarded for the risks you're taking unless you have the upside potential with equity. But as Michael alluded to a minute ago, a lot of entrepreneurs just simply don't want to go through the exercise of establishing a realistic value with you. It's tough. And so, pushing the can down the road, yes, I think that does happen. There's a lot of danger to that because the entrepreneur hasn't been brought up short and given a real sense of what the value of his company is at that point. And so you get into terms, you set expectations that are out of line, and then reality sets in the next time. A sophisticated investor comes in and sets terms that are at valuations far lower than that entrepreneur wanted and that some of the early investors wanted. And all of a sudden you've taken all the wind out of the sails of that company, and it's really hard to get momentum going again for the financing. So I think my rule of thumb has been if there's a need for less than 12 months of funding to get to a milestone that will warrant equity financing, I think some sort of convertible note that has a maturity date associated with it, a cap on the value that that note might convert at, I think it's appropriate to do debt. But if it's going to be for a financing need that is over a year, I think you really ought to have equity financing, and you really ought to push the entrepreneur to set a valuation.
Once there is a valuation, Michael, how important is that number to your decision as to whether to invest or not?
Well, the number is important only, as Ray said, you're looking for the return. So if the value is too high, you have to look at what the return will be when they sell, hopefully in the 5-year term, and whether you'll get that 10x or there's a prospect of getting that 10x. So it is an important number, but again, as we see, most deals take a lot longer in time. The valuations are really just estimates. So you really have to like the product and like where you think that the market is going to be and where the company is going to go. One other thing that I wanted to get to from the angel point of view, this is a high-risk area. That's why people like to invest in the funds, whether it's North Coast Angel or others that Charlie has. And that's because you can diversify. Because what you don't want to do is know that 1 out of 10 deals is success, but you've only invested individually in the 5 deals that have absolute failures, okay? At least North Coast, we have 23 deals in the first fund, I think 19 in the second, 21, and 18. So we have looked to diversify, and that I think is where you're going to get the returns.
Clay, how important is it to have a lead investor?
I think the lead investor is very important because if that person is knowledgeable about deal structures, is knowledgeable of the markets that the company is trying to serve, and if that party is objective in putting together a deal structure, those who are less familiar will end up with a better deal. And there is nothing worse, and I sort of alluded to that before, there's nothing worse than getting into a deal structure that ends up getting crushed at the next round of funding. And so I think if you've got a good, sophisticated lead investor, it makes a huge difference.
Then, Michael, what makes a realistic round or a fair round? How do you know when you're looking at this? Should the individual hire an attorney? Should they look to a lead investor when they're presented with a 5-page term sheet, or you'd hope not a 100-page certificate of incorporation and the shareholder agreement, all those documents? How can the average investor know if it's fair and appropriate?
So again, you have to understand the terms. You don't want to go into a deal where you're the first money in and they've taken your money and they haven't raised money from anybody else. Okay, so you want to make sure that the initial raise of your money and everyone else's money is enough to get to the company to at least a certain point. That is, whether that's 6 months out, hopefully it's a year out, but you have to make sure that there's enough money. You then have to recognize that while you can hire your own attorney, and whatever attorney you hire will work for you, the lead investor usually will hire an attorney. That attorney works for that lead investor. In theory, he's also looking at the other individuals who are joining at the same round, but he gets his directions from the lead investor, okay? And if the lead investor wants a term, that's going to go in. The lead investor doesn't want a term, it's not going to go in. What angels need to know is if you're putting $25,000 in on a deal that's raising $500,000 or $750,000, and you want terms, you're not likely to get them. The company is going to say, I've got someone putting $250,000 in, I'm going to listen to what terms they want, but you're putting in a tenth. They haven't asked for it, I'm not giving it to you. So you can look at what the lead investor terms out. You have to be comfortable that you're satisfied with them. You may want your own lawyer just to look at them so you understand them, because the lead investor may not sit down with you and go through all the terms, particularly if you're a novice. You may want your attorney to tell you what exactly you're investing in. But for the $25,000 or the $50,000, you're not going to be able to dictate terms.
So lightning round here, deal killers. Is common stock a deal killer?
No, it's not preferred, but on the right deal, you'll take it.
It's a deal killer for me.
LLC versus C Corp?
Again, you have to know the individuals. When you get to people like North Coast or something, you're only going to invest in C corporations. But if you're doing the friends and family, remember, the individual who has started that deal probably has a full-time job. He wants to take those losses, okay, those ordinary losses. So he will take it as an LLC. I have no problem starting as an LLC, but recognizing and telling my client, the entrepreneur, that you will have to convert. I know, yeah. Morris is shaking his head no, and he's probably going to fire me tomorrow. That's okay. But again, you have to look at the entrepreneur. I don't think it's necessarily a deal killer, but you have to know what the facts are. Most of the time, you want to be a C corp.
I agree with Michael, but I add a little bit more color too. One of the challenges for us in North Coast in dealing with LLCs is getting information from the companies at tax time. We have to get K-1s, and it is like pulling teeth to get these companies to produce the K-1s in a timely fashion. I think we've almost gotten to the point where we've said, we're not going to do anymore because it's just too hard. But generally speaking, I think the driving reason that North Coast is more interested in C corporations is that we anticipate there will be additional rounds of funding, typically from venture capital sources. All of those institutional VCs will require that the companies they invest in are C corporations. So at some point, there's going to have to be a conversion, and I think it's just easier when we're getting involved to start out with a C company.
I just want to add one more point. As I said, from the entrepreneur point of view, sometimes the LLC is a good option because he can take losses. Also, as he builds his team, depending upon how you get later on, if you're hiring somebody to do sales and marketing a year after you've started the company, from a tax perspective, that new sales and marketing executive is going to want equity. Giving him equity on a tax-free basis is a lot easier in an LLC than a corporation. Okay, it can be done at a corporation, but it is much more complex. So you would give what is called profit interest, and when you actually then come to North Coast or
Get a good 409A, you'll be fine.
Questions from the audience? Any? Morris?
I always hate being the first question. People say that the person who asks the first question is usually the nut job.
Never know.
So I actually have a two-part question. Part one is, from listening to you two, I think the audience and myself might have gotten the impression that the only way to do a deal is with priced equity, except in exceptional circumstances. How do you square that with the fact that more than 80% of the first round and second round deals that get done around the country are done with non-priced equity or non-priced securities?
I think that if we gave that impression to the group, I would agree with you, that's not a correct impression. I think that what we're trying to share with you is our perspective of the stage of investing that we're doing at North Coast at this point. And in many cases, it's a little later stage than some of the other companies that may be at earlier phases. And I think it is important to acknowledge that there are different deal structures depending on what part of the country you're looking at. And if you do go to the West Coast, you are more likely to see a different deal structure than you would here. And in fact, we were up at a Midwest Angel Conference in Minneapolis, and they had a completely different kind of deal structure there. So it does vary regionally, and I think we have to be conscious at our end for how changes are occurring in the marketplace. It's not a static environment. But I think that what we're trying to reflect with you is we're not necessarily at the very earliest stage of a company. We're a little bit later. We still feel there's a high degree of risk, and we do feel more comfortable taking the equity position.
Next question. Are you at two?
I had two.
A two-parter?
So the second question was, you both talked about it, and most of the people talk about it, due diligence. One of the things you're looking for is a really big idea, a really big company, which to me says you're looking for, $100 million plus exits. If you're looking for a $100 million plus exit, does it really make a difference if it's a $1 million valuation or a $10 million valuation? Isn't the range of outcomes on the outside going to be a lot different than the range of going in prices on the inside? Do you really need to worry about valuation going in?
honestly, I think it does make a difference. Because if you start with a very high valuation, and I think in the last time we did this, one of the companies that I put up was a startup that came to us with a $17 million valuation, pre-money valuation. We kind of said, holy smokes, we've never seen anything like that. And they're just setting themselves up to get creamed. And sure enough, 5 years later, they were destroyed. They had to recapitalize the whole company and start over again. I think that obviously the higher the valuation goes, the smaller your position to start with. And then I think as you get into later stages of funding, one of the challenges is preserving your rights and your ownership and your ability to offset the dilution that takes place as more funding rounds come in. If you've started with something really small, it only gets tiny. But if you've got something that's perhaps more reasonable, it'll come down to something that you might be able to see a nice return with. So I think that it does make a difference. We don't see a lot of $100 million exits. I think the average exit in Ohio is somewhere between $30 and $40 million. We see, and in fact, nationally, there is $1 billion exit a quarter. So, or something like $4 $1 billion exits a quarter. So they're really rare. I think we have to live in the world of less than $100 million, and I think that valuation does make a difference.
Thanks, so you made a comment earlier. Thanks, so you made a comment. As you look at the valuation of companies, and you early on, you try to assess where they can go. From there. It's challenging to me. I'm a debt investor historically, not an equity investor. I'm a debt investor historically, not an equity investor. Really try to understand what the potential is. You throw crazy things on one side. Snapchat companies. Or those sort of companies have a hard time understanding how you really try to assess the value. Early.
Again, I think Chuck indicated it. It said that valuation is an ideal. You have to determine what you believe the product is worth, what is the size of the market that this product will sell into, and then try and just dial it back a little bit and say, well, they can get 5% or 10%. You know, it's a very fragmented, or they have such a tremendous idea that you think as the first company in this new market, they will get a large percentage of that market. It is a guess what an ultimate valuation is. And all of the projections, as Todd showed in his earlier things, of what the value is and the sales in 5 years, those aren't going to become true. So you really have no idea exactly what the valuation is. You're relying on the idea and what you think the market size could possibly be for that product as a whole.
I think just to add to that, one of the things that we do try to do is be aware of what's going on in the marketplace generally. So for a seed stage round of funding, we typically see valuations of $1.5 to $3 million. You get into a Series A funding round, we typically see valuations that range from, say, $2 million to $7 million. I don't think that there is a number that you can say is the right number. Ultimately, it is what you can negotiate with the entrepreneur. I think that, and you know, everybody's got their own perspective, and sometimes you don't come to an agreement. But I think Michael's right that certainly the potential makes a difference. But I think there are also some norms, and you will see those norms vary considerably when you're looking at a deal here in the Midwest versus what you might see in Boston or Austin or San Francisco.
Time for one more question.
Quick comment, and then a question. I've heard both of you say, for the early convertible rounds, it's non-valuable but in effect, it's not valuing. But in effect, a discount, we are setting, for a capture discount, we are setting.
Well, if you were setting a cap, yes, you are. But the reason for the cap is that the investors are saying, we don't know what the value is, but in case the deal goes incredibly well, incredibly quickly, our money is the money that got you there. And therefore, we agree that while you think it may be worth $5 million and we think it's only worth $1 million, we're going to cap it at the $3 million today. But within a year, if you're so successful that you got someone to invest at $8 million, remember, it's our money that got you there. So we are only setting the value.
You can still calculate, that allows you to calculate a valuation of
Right.
range of valuation.
I think you're right. I think there is an element of setting a valuation, but the reality is you haven't got agreement with the entrepreneur, and that cap is typically higher than what you would accept if you were going in on an equity deal. So you're giving the entrepreneur, frankly, I think, a bit of the benefit of the doubt. But, Morris may not agree. But
I've got a different.
Morris may not
So my
agree.
question is, and I look at deals. So my question is, and I look at deals in North Country, what I see is deals hiring in Northeast Ohio tend to be more conservative. Northeast Ohio, you tend to be more conservatively valued.
I think that's absolutely correct.
Absolutely correct.
100%.
The
That's
deals,
absolutely correct.
Cleveland,
100%.
Pittsburgh, even Atlanta, out at a lower valuation. Even Atlanta, they can find out at a lower value invested in Boston than they can find on the West
In
Coast.
fact, I would even say, if you go to Cincinnati, in fact, I would even say, if you go to Cincinnati and try to see what their valuations recently are, you'll see that their valuations.
I don't believe that it's a difference. I don't believe that basically what it reflects is, anytime you do a deal, basically what it reflects is, anytime you do a deal, anytime you set a valuation, simply reflects how much risk you're dealing. The risk of the next round of funding is higher. Risk of the next round of funding is higher. There's a risk of getting that next round of funding discount for that risk. So therefore, the discount for that risk or less conservative. It's a lower more conservative or less conservative. It's a lower valuation, but it's no more.
The facts of value of the company should be the same.
Correct, it is
The facts of the why should be.
risk of getting
It's a
the
risk
next
of
round done. Which is necessary for getting the next round done.
But why
Which
is that
necessary
if the
for
same company
success?
makes the transfer of technology to that information? Why should it be different?
Because the ability to get next round funding is lower, therefore the risk is higher, therefore it's a bigger discount.
And there's less money in Cleveland chasing the better people. Chasing the
I know, but there's market movement.
Actually, that's not
I
entirely true
I
because
don't agree with that entirely. I think in principle, you're 100% correct. But in practice, when you get into a situation, the way you often see in California is there's too much money chasing a deal. You'll see the valuations tend to go much higher. And when Morris is talking about here in, say, the Midwest, where there isn't as much money available, there is a bit of a risk premium that goes along with that.
and there's also a price.
And so the price gets reduced.
And there's also a price to pay for going and getting your money in San Francisco or Boston, is that the angels there or the venture capitalists there want the companies there. A lot of angel funds, a lot of private equity funds want to be within driving distance of the company that they can control. We've seen a lot of
Brian
companies.
makes a really good point. The point that I think that you're making, aside from the valuation, okay, but the point I think you're making is, if a company is a really strong global national company, then the terms should be the same no matter where it is. There should be no such thing as terms in a particular word.
That's not what this is.
Right. However, well, no.
Global, strong.
Of course, they're not investing in regional. If you're investing in regional companies, it's a whole.
I'm not sure we're gonna solve this one today, but we'll acknowledge that and thank the panel. And invite up our next speaker.
Oh, look at this panel. Oh, man. Oh, let me help you up. Loud enough that you can.
Okay, we're going to ask the panel to briefly introduce themselves and then we'll dive back in. Please.
Lauren Richline, I'm an investor in North Coast Angel Fund 3 Venture Fund. Can you hear me? Yes? No? Maybe? And I've actually done both direct investing in startups and also through North Coast, and I'm on the board of 4 startups right now.
John Grimm, I work at Jumpstart as a venture partner, and prior to that, I had a software company that we sold in 2014. Started with 5 people, ended up with 75, and Morris has done a lot more investing than I have. I've done a few investing. I'm not quibbling with Morris tonight.
Morris Wheeler. I am an entrepreneur who has started and exited a number of companies, both in the technology field and in the industrial field. I run a local investment group called the Drummond Road Capital. Before the explosion in microcap investing, we were pretty, on a regular basis, named one of the top early stage investors in the country. We invest in deals in Ohio and around the country. And typically I don't like the term angel investing because I don't know about any of you, but I invest to make money, not because I'm a nice guy. Just asking me.
You just opened your mouth.
I know.
Being a nice guy is just a bonus.
Right.
So John, we'll start with you. We talked about jockey versus horse before. You've made the decision to invest. You're going to spend a lot of time with the jockey. As the board member, do you consider yourself more governance, meaning the boss, or advisor, friend of the CEO?
Never a friend, but you are a coach, and you are also a board member, and you're striving to make your executives, if it's more than one, excel at what they're doing and drive the opportunity forward. So there's the entrepreneurs tend to surround themselves with people they think that can help them, and so yeah, you are a deep coach. But you also have to make sure that entrepreneurs, toe the line. You can't operate outside the operating agreement because, boom, that's bad news. You do that once and you're going to be hard to invest in again. And so it's really a dual role. And early stage investors, you can't crack the whip too hard. Early stage entrepreneurs, but you clearly want to guide them and try to accelerate their opportunity.
And Lauren, what are the characteristics of a good board member?
It depends on what stage the company's in, but I'd say that the prevalent trait is somebody who might know something about the business that they're in that would be a good start, or somebody who has really good finance skills, because typically the entrepreneur doesn't. But it's really somebody who shows up, who's there, who understands you can't just come in and out, that you really need to be very present and very there all the time, because a lot's happening with the entrepreneur, and a quarterly check-in just isn't going to do it. But, you know, depending on the stage of the company, I mean, I think of Morris's style of being somebody who's very hands-on and very prescriptive. That's very appropriate in some cases. In other cases, it really isn't. You're really there, as you said, more to coach, be a sounding board. And I think I've met some board members who it's like my way or no way. That's just not a good characteristic of a board member. That's not what they're there for.
And Morris, how involved do you like to be? When do you want to be called? When would you like to have input into a decision?
It may surprise you to know that I'm going to reject the assumption that I am a board member. In an early stage company, we never take board seats. We don't believe in taking board seats for a number of reasons. Number one, if you need to be the person that is telling the entrepreneur what to do, then you've probably picked the wrong entrepreneur. And in a really early stage company, the role that you need to be playing is as an advisor and as a helper. That is a much more ongoing role, a much less formal role than a board role. When we make an investment, I tell the entrepreneur that the cadence is going to be up to them. Some entrepreneurs I talk to every week at the same time. Some I do only talk to once a quarter. Typically, it's no less than once a quarter that we talk to them. But I think that the bottom line is that in early stage investing, you should be adding value of some kind. And being a board member isn't necessarily going to be value add as opposed to being an advisor. And maybe more importantly, you know, Drummond Road does 10 to 12 investments a year. And as we've already heard in the stage of investing that many of us are doing investing, 50% or so don't do well. And Todd, I know you've been through this before. The bottom line is the board members are the ones who are left to clean up the mess when the company goes under. So from my point of view as an investor, I'd much rather be an advisor than a former board member.
John, do you have a different perspective, or whether it's an advisor who's close or a board member who's close, how important is it that you play that role with a company you invest in versus someone you know and trust versus whoever the entrepreneur wants to work with?
I would much rather be someone who counsels the entrepreneur on a day-to-day, a week-to-week, a month-to-month basis than be a board member who's trying to adhere to an operating agreement. Entrepreneurs, they need support. They don't need somebody that's slapping them on the back because they did something wrong. Although, I mean, if you are a board member, you have to watch that. Because you can't, you don't want anybody committing fraud. I've seen that before. It happened to me on one of the companies I invested in. And I was on the board. I'm no longer on that board. So I think it's really important to determine where you want to be. Like Morris said, you want to be an advisor and somebody who assists, or do you want to be on the board because you want to be on the board? I mean, that's a self-selecting kind of situation.
Laura, whether you're on the board, an advisor, or just an investor, are there ways you think about adding value to the company up front and being active, or are you okay being a passive investor in the company?
It really depends on the situation and one that I'm on. I would say I'm fairly passive. It's not somewhere where I've got an area of expertise. I'm really helping more on the finance side. But it depends. I mean, the company that Sharon was referencing, when she was up here, where I'm North Coast designated board member, I'm in constant contact because I'm able to open my Rolodex because I know a lot about this industry, and I can make a lot of connections. So I would say that's a very active role, it's a very constructive role, but I'm not trying to prescribe anything, and I'm there as an advisor. But it depends on the stage that they're at. If they're going through fundraising, I don't add a lot of value. I mean, I can in terms of making some introductions. if they're further along, it turns into a more normal board structure where they're reporting in and making sure they're on track. It's a little bit more governance than really advising.
And then, John, when is the right time to seek VC investment?
When you have a good story to tell. And that's going to vary depending on where you are. We've all been talking tonight already about locations, West Coast, East Coast, Heartland. So let's talk about Heartland because that's kind of where we are. I mean, in Bay Area, you can go out with a 3-pager and probably pull down $5 or $6 million and have no revenue with just an idea. That's not going to happen here. So when you go to a VC around here or in the Midwest, you want to have traction. You want to have a certain set of metrics and KPIs that are telling the story that your company is going to be successful and you can achieve something big. So, you know, most VCs around here want to cut a check no less than $1 million, if it's not $2 million. So if your company is in a situation to warrant that kind of capital, it's probably not going to happen around here. We're seeing a little bit of changing and a few companies coming in and looking at some of the opportunities that are in this neck of the woods and cutting some decent sized checks for fairly, you know, early stage businesses, but still the norm is you need traction, you need legs. And when you have that, you can go out to the investor.
Then worse, early entrepreneurs tend to focus on building products and selling products. But as an advisor, how or when do you get engaged saying, now's the time to think about raising capital, now's the time to go out to the follow-on community, or now's the time to think about an exit?
Let's start with now's the time to think about an exit. And in my mind, no company that's not in trouble is thinking about an exit. Exits happen. Companies get bought. Good companies get bought. They don't get sold. And from my standpoint, you think about building the best company that you can possibly build. You never think about who's going to buy me and what do I need to do to get them to buy me. Because if you're building the best company you're going to build, then there's a good chance that your company will someday get bought. If you have to sell it, it's typically because you haven't achieved what you've wanted to achieve. In terms of when you should be thinking about raising money, always. The bottom line is your entire plan should be based on not what this round is going to look like, but what the next round is going to look like and what are the metrics I need to reach to get there. And what's it going to cost me to get to those metrics? What steps do I need to take today to get to those metrics? What does it look like? You know, from day one, the first question one of the first questions I ask an entrepreneur when I meet them is, what does your company look like at $100 million a year in revenue? And if they can't answer that question in a general sense, even better if they can answer it in a specific sense, then I don't really have an interest because it means they're not thinking big enough. But it also means if they're thinking about what is my company going to look like at $100 million in revenue, they're also thinking about how much capital is going to take me to get there, how should I stage it, when should I bring it in to make sure that I own the most amount of the company at the time when I get there.
So quick lightning round. More
Todd, can I add to that before you have to go to lightning round? So many of us in here have probably experienced exits, either with portfolio companies or personally with your own company. I know Morris has and Charlie has and several other people out there. Just going to give you an example at notice. What I want to do is explain what Morris said about being sold versus being bought. When we sold our company, we never hung a for sale sign on our door. What we did was enlist a couple of people that had the right Rolodexes that could go out and open doors for us to talk to people that could be potential partners, i.e. acquirers. And so you just start talking to those people and you keep telling them the good news of what you're doing and how things are happening, and all of a sudden they come in and they say, well, what about if we buy you? You say no, and they come back again. You say no, they come back again, the price is double, and you say, okay, I think we can work a deal here. And that's what being bought versus being sold means. Being sold is where you hire an investment banker, and I was an investment banker at one point in my life. Yes. And you write a memorandum and you ship the book out to everybody you can to try to generate some interest. But the best way is to be bought and have inbound interest versus outbound interest.
So how often do you want to hear from an entrepreneur operationally? Just to get an email saying, here are the wins, here are the losses, here are our sales, here's how much cash we have. How often do you like to see that cadence?
So in my role at Jumpstart, it happens daily to weekly. And that is perfectly fine with me. I make an allocation for that.
As an advisor, you can't advise a company or mentor a company unless you know what's going on. And you can't know what's going on unless you're hearing from the entrepreneur on a regular basis, which typically means weekly at least, but much less than weekly. You're just not going to be up to date on what's really going on in the company. You're not going to be able to offer them great advice.
The only thing, I mean, I would agree weekly, but I've got one company where really it doesn't make sense given the business they're in for me to hear from them except for quarterly because things are moving glacially, but that's appropriate in that case.
Yeah, it's definitely situational.
Questions from the group?
John, in light of the comment you just made about investment bankers, how would you describe the appropriate role for an investment banker? When do you bring one in, or when do you, and what can they offer when they come in?
Sure. Investment bankers play a really important part in our ecosystem. We had an investment banker, but we specifically instructed him, we're not writing a book. All we want you to do is use your Rolodex and go out and get us people to meet. That's it. We'll pay you the same price as if you were an investment banker writing the memorandum and going out there and trying to create an auction situation, you know, and selling us for the highest price. But that's not what we wanted. And so we did hire an investment banker, and we paid him a pretty price at the end of the day. So I think investment bankers play a critical role in the view that Morris espoused and the one that I espoused.
What about during the actual transaction process? Do they play a role, or did they play a role in sort of the good guy, bad guy, trying to negotiate a price that was sort of the maximum price?
Yeah, they played a role, but the most important role was, again, opening the doors, and then after that, being our Slack and managing. Everybody know what the program Slack is, the platform Slack? I don't want to use that without people not knowing, but our investment banker made sure that we were communicating with everybody appropriately at the right time, with the right content, and just kind of keeping internally advising us as to, you know, how that was happening with different parties, and different parties react differently, so we had to react differently to, you know, potential suitors.
Regarding your comment, I don't understand why the auction process is bad, because in my vast experience of exactly one case, I think it got the highest price.
Well, I'm not saying it's bad. It's just not the route. I think that getting bought we created an auction within our environment, but we never did it by like hiring an investment banker to write up some investment memo and send it out to 25 to 50 companies. We were dealing with 4 companies. They all knew it. It was what we call a quiet auction, and one of them really wanted us, and we said, this is the bar, and they said, okay, that's the bar. So auctions are not bad. It's the question of how you conduct it.
In our case, the best buyers were companies that I would have never thought of. The investment banker found them. I didn't.
Yep. For sure. Yep.
So first of all, I think what we're talking about though here is a much later stage, more mature company than the companies that we're typically investing in. If we're lucky enough to get to the point where there's a need for an investment banker, then you're probably much further down the road than the types of companies that we're typically investing in. And in my view, the proper role for investment banker is dependent upon the team that you have. You know, in my case, I worked on Wall Street and I worked as an investment banker early in life, so I don't bring an investment banker in until I basically have an initial interest on the table, and I want to make sure that we're going to get the best price to do exactly the kind of things that you said about. To bring others to the table that I may not have thought of, that we may not know, et cetera, et cetera, et cetera, and to hold a proper product. But I think the difference is when you're talking about a really early stage company, if you're talking about a seed stage company or a Series A company, there's no process. If you're talking about selling the company, it's because something went wrong. And what you're really talking about is how do we get, you know, as much as possible out of this thing and find a soft landing for the employees. That's a much different case than a mature company when you've got inbound interest and you want to maximize the price.
I'm going to ask you guys the pricing question. How much do you help your guys go from cost plus pricing to value pricing? How do you do it?
Pricing is it's really a tough one, and the bottom line, and I think that as we heard earlier, like everything else in an early stage startup, it's a process of A/B comparisons and experimentation. You basically start with a hypothesis and you test it and you see what works. And you know, the idea that you start from a higher price and go lower, I think personally is a lot easier than starting from a low price and trying to go higher. You can do that if you're adding services. You can do that if you're changing the nature of your offering. But I think in a general sense, it's a lot easier to start with a hypothesis of a higher price and go to a lower price. And as Sharon pointed out earlier, if somehow you can figure out how to make it a recurring model, all the better.
I would just add to that one of the companies I'm working with has been out there trying different price points, and the companies that they're targeting aren't going to talk to each other, so they've had this luxury of experimenting, and they've been actually uncharacteristically been able to raise their price as they've been going out there. Yeah, so it's actually, it's unusual, but it's working.
In many instances, it's a crapshoot. And you're just going to have to test, like Morris said. I mean, in our early stages, we tested with very high prices. We loved the companies that accepted that price and helped fund us organically. And then when we got into a more professional situation where management knew what they were doing, or the managers that knew what they were doing, obviously we would look at what we would call more average market pricing. But so we were optimistic. We looked for people that we could grab some high prices from. We looked at people that knew what they were getting, and we had to give them lower pricing.
Well, thank you very much.
Thank you.
We will invite up our final panel and remind everyone that we have a door prize.
I was just going to ask
we
what
will
the
be
was.
giving this away after the final panel for those who stick around.
All right.
Would you like to switch any seating?
Okay, so Clay, since you've already introduced yourself and everybody here has a sharp memory, we'll start with Susan.
All right, I'm the only new face on this. So I'm Susan Luria. I run the business side of integrative medicine for university hospitals, and I have been a member of North Coast Angel Fund for as long as it's been around, so all three of the funds.
How many deals do you all see in a year?
In a year or in total?
Let's say across the year, how many opportunities might you take a look at?
I think we might see something on the order of 150, 200 deals in a given year. I think our rule of thumb is that we will probably seriously or invest in about 2% of the deals we look at.
My vehicle is North Coast Angel Fund, so that's my answer, but we also, as a family, look at about 10 to 20 different opportunities a year individually.
So we looked at 300 deals last year. This year, I think we're going to triple that number for a really specific reason. We're going to, and I think this has been alluded to a little bit, but there's a huge influx of seed capital money in Northeastern Ohio because of the state of Ohio's Third Frontier program has literally dumped over $100 million, including the match, just into Northeastern Ohio. That's entirely dedicated to seed stage funding. So there's this enormous opportunity for Flash Starts in particular to really ramp up our business this year in order to feed that kind of demand. So while we looked at 300 this year, I think we're going to at least try to triple that for this next year.
Great, and then Clay, for individuals who are not part of a fund or a Flash Starts vehicle, how should they think about building a portfolio? How many investments does one need to have to feel like there's some base level of diversification?
The Angel Capital Association did a study on that topic a number of years ago and determined that if you've got a portfolio of somewhere around 18 companies, you start to mitigate the risk of this kind of early stage investing. And that was really the rationale for why we set up North Coast as a fund with the goal of that many investments. We did 21 in the first, as we mentioned earlier, and 18 in the second. I think that the issue that we all face as individuals thinking about this kind of early stage investing is how much time do you have to build that kind of portfolio personally. It's really time consuming. And to do the due diligence, to do the deal documentation, everything that goes along with the investing, it takes a lot of time. And if you're not prepared to do that work individually, I think that was really why we created North Coast the way we did as a fund.
Susan, how do you think about allocating capital for the second investment, the third investment, and potentially additional investments in a given company?
That is a great question. What I've learned as an individual investing in this really for fun is that check that you write when you get excited about a company is not the only check that you really should write. You should really think about tripling that amount, setting it aside. And that's something that I've had to learn over time, which has been great, actually, to have the opportunity to participate with North Coast Angel Fund, because I've got the portfolio approach, and then I sort of have the play money on the side, knowing that if I'm not going to invest personally in the 18 companies, but I'm going to pick 3 that are exciting to me, I should put aside some money. Effectively, I shouldn't say this because I think a lot of people in here are trying to make money on this, but when I put money into a company, I write it off, and I assume that that's a loss, and anything on top of that is fantastic. And I look at it as a way of investing in Cleveland, investing in companies, investing in startups, and I sort of look at it as a way to participate in this community, get to know some people, and maybe get lucky.
I'd love to just add on to that. I think Susan's comment about writing it off is a very healthy way to think about this early stage investing. It sort of gets you over the baggage and frustration of seeing the company struggle, and invariably these early stage companies struggle. But what I think is also important is that with that first investment, you're kind of paying to play. And I think Ray actually was talking about this earlier. You're kind of giving yourself a window into the opportunity so that as the company evolves and the opportunity for additional investment unfolds, you can continue to play, and you may play in a bigger way. We've got a situation right now in one of our portfolio companies where the company has performed flawlessly, but the funding environment has been very difficult. And the most recent round of funding that's been proposed is at a substantial down round from what the last round of funding was. So if you've reserved some money for that follow-on round of funding, you get in at a very attractive, on a set of very attractive terms. So it's not always a bad, I mean, I'd say it's a good idea to hold money in reserve for that follow-on investment.
Charles, how should the average investor cast a net and expect to find enough good deals to build a portfolio?
That's a great question, and I'm not going to tell you. I can only tell you how we do it. So we actually have an online service called F Success, where we put up our program and entrepreneurs from around the world apply, and then we go through that. We've got a couple companies from that, but we kind of reversed their model. We actually go into that database and recruit companies that didn't necessarily apply to us, apply to 5 stars, but are in that database. So we'll go out and proactively recruit companies. It's not dissimilar from college football coaching, where you go identify the best opportunities, cozy up to their parents, and say, it'd be great looking here at 5 stars. So we do a lot of recruiting. We spend a lot of time in universities, not so much for the undergraduates, but for the graduates and alumni, where they tend to be hotbeds of innovation and not so much a more entrepreneurial spirit, but more entrepreneurial readiness in order to start a new company. So we do a lot of time in universities and a lot of proactive recruiting to look for the best opportunities.
And Susan, when you look back at companies you've invested in that have gone well or those that have not gone well, what have you learned? What are the common denominators with the benefit of hindsight?
I would say if it's a complex idea for me to understand, it's going to be a complex idea for a customer to understand. So it's got to be simple, memorable, and you walk away and you still know what that product is. And also having a clear understanding of who the customer is, who's actually going to buy the product, and a clear line to that from the very start. I think those are 2 things I'd love to have known earlier.
Not so much to disagree, but to put another spin on that. I think the company that will turn out to be our single best investment is a company that literally took me months to figure out what they were doing, even what the heck they were talking about. And I walked into their room on one occasion, and they had a giant whiteboard filled with math. There was not a single number involved. And it was absolutely daunting, and I still am not exactly sure at the lowest level what exactly they're doing, but their success is unqualified. I just know the money comes out the other end. What are you looking for?
So if, for each of you, if you could change one thing about Northeast Ohio's ecosystem, whether it's what's going on with entrepreneurs, what's going on with angel investors, what's going on with VCs, what would you like to see improve?
Well, I think I already answered that question, but I'll just reiterate it for those of you that were chewing or drinking. We need way more companies in Northeastern Ohio. The amount of seed stage money is unmatched in the past. It's an order of magnitude more than has been here before. And honestly, we don't have the early stage deal flow. So if you have relatives or friends or family members or contacts or random people you meet overseas, tell them that there's a whole pile of money in Cleveland just waiting for them.
I would actually duplicate that. It's actually, and also a less conservative environment.
Couldn't agree more with Charlie. At our annual meeting last week, I think that if we could have more Charlies, more accelerators in Northeast Ohio, it would be a great benefit. The other thing that we are missing, and it's going to take time to get over this, is the experienced entrepreneur. Most of our entrepreneurs are first-time entrepreneurs. And I think that it's just harder for them to figure out how to move their companies forward because they're doing it for the first time. And so for the people like Morris and others who are counselors, advisors, like John, they are really needed because these entrepreneurs are just learning.
And for each of you, what's one company that people may not be familiar with in Cleveland that they should know about or should be interested in?
Well, I'll just tell you who I was talking about earlier that I don't understand. The company's called Remesh, and they had a technology that it takes a long time to understand. They had a whole number of market opportunities into which they could have launched. They chose market research firms because they understood what the benefits were and were willing to pay a great deal of money to use the service. And I think they have a serious chance at being a very, very large company as they expand in other markets. And basically what they do is a combination of natural language processing, artificial intelligence, and allow groups of people as large as 100,000 to communicate as if they were one person. And to watch it happen is an extraordinary experience.
I actually like one that has been, was started by two Cleveland guys. One is living in Nashville right now, the other's in New York. It's called Breathe Aware, and it is it's an online health company that does stress management. So it's an app on your phone, and in 90 seconds you can kind of run through brain reboot. And given what I do, I think it's a really neat product, and I'd love to see these two entrepreneurs return to Cleveland to build a company.
A company here in Cleveland that those who came to the annual meeting last week would have heard from, called Genome Oncology. They have developed algorithms that allow them to identify drugs that are most likely to be effective in fighting certain kinds of cancerous tumors and be least adversely impactful on the patient. I think a very exciting company. This field of genomics is just exploding right now, and that's one to watch.
Shark Tank, realistic or unrealistic?
Well, it's on TV, so it's got to be unrealistic.
My 14-year-old thinks it's realistic.
Unrealistic.
Okay, last question before we go to the audience. When you just look at your memory banks of all the deals that you've seen over the years, which one stands out as being the most unique, the most memorable, the wildest pitch you've been privy to?
You take the mic.
A company called Chip and Wales, which is enabling average-looking guys to have the opportunity to be male dancers. That's one out of Nashville.
Did you invest?
So we hold a lot. One of the ways we get teams is we hold pitch competitions. We do them all places. We do them in bars and restaurants and colleges and in our facility. We do a lot of pitch competitions. And there was a guy who stood up at a pitch competition and said, "Let me tell you about the properties of termite spit." And it was fascinating. He's actually out building a company now based on the chemical properties of a derivative of termite spit. But the single best way to start a presentation I've heard.
I'll have you know that there's a couple people here that are involved in that.
I know, and I couldn't be more excited.
Like crazy.
What's your favorite? Maybe the Baconator? Would you like the Baconator?
I think that's a pretty good one. I don't know. We had one that basically produced artificial meatballs. They used fillers to make these meatballs, and they thought they could sell this to all of the, McDonald's and everybody else, save money. It seemed like a pretty crazy idea. But the Baconator's right up there, cooking bacon sort of one slice at a time.
What's that? Another one, sure.
So almost in the same vein, based on animal-based products, a company now that's in our labs program, we haven't invested within our labs program, is out of the University of Akron's biomimicry department. And they're studying hedgehogs, because when hedgehogs fall out of trees, which they do because they're really bad climbers, but they like to climb, when they fall out of trees, they roll themselves up into a ball and fall. And their spines are such that it absorbs the impact better than any human material. So they're researching the ability of taking hedgehog spines, not the real ones, they're not, no hedgehogs will die, and turning them into liners for football helmets.
Questions from the audience? John?
Question for Todd. Todd, how crazy do you think Delta Technologies was?
Delta Tech, and for the group, remind the group.
Delta was the company that wanted to make rubber out of dandelions.
So we have seen companies that rubber out of dandelions, tires out of carpet, extracted chemical products out of tires, and miscellaneous beads into free trade bra straps. So we have seen everything over the years, and what's wild about some of these companies is they might just have something, right? As silly as some of these ideas may sound at the beginning, almost all the entrepreneurs are some level of brilliant if they're pitching something like that, right? They have many of them, organic chemistry PhD background. They've thought about these problems and they've started to test it. So you really never know when you get involved what is an interesting story versus what the next billion-dollar company is. And I haven't kept track of them. Are they still running?
I have no clue.
We don't know. We'll get back to everyone.
Question for Susan, at the risk of challenging questions. So Susan, you mentioned, I think you said that as you invest money in these funds, your expectation is you get no money back, but you hope for more. Is that what you said before?
Yep.
Essentially. So as a potential investor in the third fund, how should I think about that? Given that I would like to make a good return.
Well, actually, more what I was saying is the fund it's the portfolio approach. So if the number is really 18 to 20 companies and one will return, one will be the hit out of that number. Chances are, if you invest in the fund, you'll get your money back from the fund, and if not, slightly more. And then I do the sidecars as the complete write-off money. The fund gives you the opportunity to see the opportunities, and it gives you the opportunity to play and participate. And you probably actually waste a lot more money doing other things, so it's a great investment.
I do want to underscore that.
That wasn't a good sell.
No, I think it was very well stated, but I do want to underscore that our goal is to make money. And you saw on the slide up there that the target return on investment in this early stage stuff is about 27%. So I think anywhere in that 24, 27%, that is our target IRR.
I think the one thing we can probably guarantee from a fund perspective is that 12 times a year there will be an opportunity to come to a venue like this and have food and alcohol and look at fund companies. And beyond that, we have to be optimists to go forward with this kind of activity.
What's the latest status with like Third Frontier, and how does that affect seed funding in Northeast Ohio?
Status of the Third Frontier program. I think that they've got about another $260 million left to support all of this kind of early stage activity. There hasn't yet been discussion about going up for another bond issue that would allow them to raise more money. I think that there are different elements of funding that the Third Frontier program is supporting. It starts in the entrepreneurial services program like Jumpstart. Their funding is set at $20 million a year, last year, this year, and next year. So they're pretty well, or pretty clear. There is no planned funding that we're aware of for the pre-seed and seed plus funding that we're involved with for 2017. We don't know what will come in 2018. There's no discussion yet. There appears to be a cutback in the Commercial Acceleration Loan Fund, CALF loan program. Our understanding is they're going to do away with that in 2017. That has been a loan program from the state that has supported a number of our portfolio companies. So I think the Third Frontier program is still is a program in flux. It's hard to know where the future will go, but it's had us. I think the impact is still significant.
Time for one more question.
So I had a question about money. Clay, I thought you said there was no money or little money. Charles, I thought I heard you say there's lots of money.
What I'm referring to is there is no money planned going forward. The money that Charles was talking about is money that's been committed and is already in place. So that is, we've got a lot of money out there. And in fact, I think Charles said to me the other day, there's probably enough money to fund a couple of 100 startups. And if Charlie's the only one in Northeast Ohio that's producing, what, a dozen companies a year, there's a lot of opportunity to fund companies. And I think if we had more accelerators, we'd be able to take better advantage of the money that's already out there.
We thank everyone, and we're going to involve everyone in this process. Charlie, we're going to ask you to stir them up. Susan, we're going to ask you to pick, and then Clay will be the winner.
Oh, now you're going to have two.
All right, this is too easy to grab. Those are soft now.
Yeah, you're in there, Darius.
Oh, I'm sorry.
Yeah, it's okay.
Really wants that ball. They have to be here.
And the winner is Stuart Van Wagner. Where is Stuart?
He left.
No, he's not.
Congratulations.
We're making this happen. Get the shot back. Come on. Who pulled it out?
That was me.
I was so excited to share until you left.
And I was able to read
On that note, we will thank all our panelists. We will thank
On what note?
and wish everyone a good evening. Thank you.